A couple of other items here. Chattel paper. It's writings that evidence both a monetary obligation, which says buy equipment on credit. The loan agreement then becomes the collateral for another loan by the previous creditor and a security interest in specific goods. It could be intangibles like an account receivable, any right to payment for goods or services, or a negotiable instrument, warehouse receipts, bill of ladings. So it could be a tangible collateral. It could be an intangible collateral. But the key point here is as follows. I loan you money, or I give you credit to acquire this asset. What happens is we then take the asset as collateral for the loan. For example, I go to the store. This is Sears. This is RP. I go to Sears and I go, hey, I like that TV. How much is it? They go $3,000. Wow, I love this new 147-inch TV. Right? They just keep getting bigger and bigger. So I go in and I say, okay, let me go ahead and get that. So I give you my credit card, for example. And I give you my credit card so I can get the TV. I give you my credit card, you run it through. Basically what you're doing is you're giving me the credit to buy the asset. And let's say that's a TV. What is the asset to me? The TV, it is consumer goods. You then don't physically, but legally, you take the TV as collateral for the loan, which means that if I default and I stop paying, you're going to come to my house and take back my TV. My kids ain't going to like you, but you're going to take back my TV. Same thing with equipment. You loan me money, I buy a piece of equipment. Legally, you take that piece of equipment, and if I don't pay, you'll legally come in and take that piece of equipment. So that is the concept that we're dealing with. Now, in order to do this, who are you trying to protect yourself? Who is the creditor trying to protect themselves from? They're trying to protect themselves from DOTS, D-O-T-S. They're trying to protect themselves from the debtor, from other creditors, from a trustee in bankruptcy. B circle means bankruptcy for the next few sections. Or finally, a subsequent purchaser from debtor. All right, let me show you this example. All right, so they want to protect themselves from the debtor, which means that you gave me the money or the credit to get the asset. You want to protect yourselves. If I don't pay you, you want to take it back. From other creditors, you loan me money to buy the TV. I no longer have the TV, but I have other assets or I have other creditors. Well, let's back up. You loan me money to buy the TV. I then go to another store and I buy 100 pairs of Calvin Klein underwear. Okay? I don't pay for the underwear. Do you think the store wants to come and take my underwear? I don't think so. All right? But they go, hey, nice TV, we'll take that. Sears wants to go, no. You can't take the TV, it's mine. Other creditors. Let's say I go bankrupt. Trustee in bankruptcy comes in, wants to take all my assets. Guess what? They say, no, the TV's mine. Or if I take that TV and I want to sell it to another consumer. So I sold it to someone else. Now, that person has it. Sears wants to go to their house and take back the TV. So who is the creditor trying to protect themselves from? DOTS. The debtor, that's me. Other creditors, trustee in bankruptcy, or a subsequent purchaser who buys the TV from me, another consumer. That's who they're trying to protect themselves from. Now, how do you protect yourself? The way you protect yourself from me, the debtor, is to attach, called attachment. If they can attach, whatever that means, in a minute we'll learn, they get the TV back from me. In order to protect themselves from me and or these other third parties, they need to attach and perfect, which we call perfect or perfection. Attachment and perfection. So in order to get it back from me, they just need to attach. In order to get it back from the other third parties, they need to attach and perfect. Because you can't perfect without attaching, you can't attach without perfecting. Again, in order to get it back from those third parties, they need to attach and perfect. Now, let's look at our notes. What are these third parties? You'll see that on the next page. DOTS, debtor, other creditors, trustee in bankruptcy, subsequent purchaser from debtor without knowledge of perfection. Note, for the creditor to protect themselves from the debtor, they must only attach. To protect from the other parties, oughts, they have to attach and perfect. Now, there's something back on the first page called a PMSI. What is a PMSI? That's called a purchase money security interest or a purchase money creditor. What does that mean? That means that the creditor gave you the purchase money to buy the asset that became the collateral. That means without them, I couldn't have bought the collateral. Do you see that? So they gave me the money or the credit to buy the asset that became the collateral. That's called a PMSI. A PMSI will have extra special rights. Why? Because they're the ones, without them, I couldn't have bought it. What is an example of not PMSI? Let's say I go to the bank and I borrow money, and I'm borrowing money to add a patio to my house. Okay? Are they taking the patio as collateral? They don't want the patio. What are they going to take as collateral? My car. Did they give me the money to buy the car? No. They gave me money to build a patio, but then they took this other asset as collateral. Is there a chance that someone else already has a better interest in the car? Yeah. Therefore, that's not PMSI. So again, PMSI, purchase money security interest. In a PMSI, they gave you the money or the credit to buy the collateral. Look in your notes. When the creditor gives the debtor the purchase money or the credit to acquire the collateral, this gives the creditor priority over all other types of security interest in the same collateral. A PMSI is an interest in personal property or fixtures that secures payment of an obligation that is either taken by the seller of the collateral to secure all or part of the price, or taken by a person who loans money or extends credit to enable the debtor to acquire the collateral. Okay. So far what have we got? A quick overview of what secured transactions deals with. In a minute, we're going to say, what does it take to attach? What does it take to perfect? We'll look at that in just a minute.